What happens when the global financial machine stops caring about making money and suddenly starts worrying entirely about survival?
It forces a total rewiring of the global economy. I mean, the rules that govern trillions of dollars just change overnight.
Welcome to this deep dive. Today, we are unpacking the hidden mechanics of a risk aversion regime. And we are not talking about a bad day on the stock market here.
Right.
We're not talking about a disappointing earnings report from some tech company. We are looking at the invisible architecture that dictates exactly where global wealth moves when the world catches fire geopolitically.
Yeah, this is a macro analysis of global market behavior. We are basically looking at the structural foundation of the world economy. And most of the time, that foundation operates quietly in the background.
Right, nobody pays attention to the plumbing when the water is flowing.
Exactly.
Mhm.
But when geopolitical stress hits, when you have military confrontations, energy supply shocks, massive trade wars, that invisible architecture suddenly dictates the survival of entire nations' economies.
And that is why this matters to you, listening right now. If you want a shortcut to decoding the chaotic global headlines you see every single day, you have to understand this hidden structure.
You really do.
You need to know how the global financial plumbing actually works when the pressure gets turned up. Because if you understand the mechanics of panic, you stop reacting to the news. You start anticipating it. Now, here's where it gets interesting. Normal markets are actually an illusion.
That is a really fascinating way to look at it. Because to understand how the system breaks down during a panic, we first have to understand the baseline. We have to look at what the financial world considers normal.
Which is a state we call a risk-seeking regime.
Right, a risk-seeking regime.
So let's build a mental model of that. What are the core characteristics of this baseline?
The defining characteristic is abundant liquidity. Money is cheap, it's easy to borrow, global trade is expanding, and political conditions are generally stable or, at least predictable.
They make sense.
Yeah. And under these assumptions of stability, the people managing massive pools of capital, they look out at the world and evaluate fundamentals.
Yeah.
They look at economic growth trajectories, corporate profitability.
Technological innovation.
Exactly.
So they are essentially looking at a map of the world and asking, where can I plant my money so it grows the fastest?
Yes. Wait, let me rephrase that a bit. The capital naturally seeks the highest possible return because the baseline assumption is safety. Investors become incredibly comfortable taking on risk.
Right.
So they buy equities, they buy emerging market bonds, they invest in high-growth, speculative sectors. The entire financial system is geared toward expansion. Credit grows, leverage increases, cross-border investment flows become highly dynamic.
And the sources point to a phenomenon that happens during this time called the compression of risk premiums. Let's break that down because it sounds like heavy financial jargon, but it represents a deeply human psychological trap.
It really does. So a risk premium is the extra compensation an investor demands for taking on a riskier asset. Let's say you have the choice between lending money to the U.S. government.
Which is virtually guaranteed to pay you back.
Right, guaranteed. Or lending money to a newly formed tech startup. You are going to demand a much higher interest rate from the startup to justify the risk of them going bankrupt.
Makes total sense. If I'm taking a bigger gamble, I need a bigger potential payout.
But during extended periods of stability, something shifts in the collective psychology of the market. The perceived risks simply decline. Investors look at years of steady growth, and they start to believe the startup isn't actually that risky.
So they start accepting a lower interest rate from the startup. The gap between the safe investment and the risky investment shrinks. That is the compression.
The gap shrinks to almost nothing. Credit spreads narrow, volatility declines. Investors just gradually accept less and less reward for holding increasingly risky assets.
Because they become so confident in the macroeconomic environment that they stop demanding a safety net.
They do. They're basically picking up pennies in front of a steamroller, but they are absolutely convinced the steamroller is permanently out of gas.
That's a great analogy. The financial system begins to operate under the absolute assumption that systemic disruptions are impossible. People start believing that central banks have somehow outlawed recessions and that geopolitics are a thing of the past.
Which brings us to the narratives, the stories the market tells itself during these times.
Right. The market narratives during a risk-seeking phase are entirely focused on opportunity and expansion.
Completely. If you turn on financial television or read market analysis during these periods, the focus is relentlessly optimistic. Analysts are obsessed with innovation.
Expanding global integration.
Yeah, they focus on the next big technological breakthrough.
Everyone is hunting for the next paradigm shift. Capital pours into emerging markets and cyclical industries because the justification is always the same.
The broader environment supports endless expansion. The paradox here is striking, though. Markets appear incredibly stable during these periods of risk premium compression. But that stability is deeply fragile.
Because everyone has priced out the possibility of a shock.
Exactly. The system has zero shock absorbers left because nobody thought they needed to pay for them.
Which makes me want to ask you, the listener, have you ever noticed how right before a major global crisis, the financial news is usually obsessed with a new tech boom?
The obsession with growth creates a massive blind spot to structural vulnerability, and that sets the stage for a violent correction.
And then the catalyst hits, the illusion shatters.
The trigger. In the context of our discussion today, we are specifically looking at geopolitical stress.
Right. We are not talking about a bad jobs report.
Yep.
We are not talking about inflation ticking up by 0.1%. We're talking about military conflicts. We're talking about critical energy supply lines being severed, major trade wars or sudden strategic clashes between superpowers.
These events are unique because they introduce a completely different type of uncertainty into the global system. This is not something a quantitative analyst can easily plug into a spreadsheet.
Right. You can model consumer spending patterns based on historical data. You absolutely cannot model the unpredictable escalation of a major geopolitical conflict.
Because these triggers threaten the actual physical and political infrastructure of the global economy.
They threaten supply chains, international borders, they threaten the global financial networks themselves.
Which forces a sudden and brutal shift in the dominant market narrative. The conversation changes almost overnight.
We go from a relentless focus on opportunity and expansion to a sudden obsession with resilience and vulnerability.
Analysts completely pivot. The people who were projecting 10-year growth models for tech startups are suddenly mapping out global shipping routes.
Tracking the flow of crude oil through specific straits.
Yes, they are analyzing the vulnerabilities of international payment systems.
The media coverage flips. It becomes all about tracking instability. But how does that realization actually look in the markets? When the shock first hits, what are the early tremors?
The earliest reactions almost always appear in volatility measures. Markets start experiencing sudden, violent price swings. Participants are urgently reassessing their risks.
Looking at their portfolios and asking, how exposed are we to this specific region? What happens if this energy pipeline is shut down?
They are running stress tests in real time.
Right.
And you start to see capital tentatively flow into traditional safe haven assets. Gold usually sees an immediate inflow. High-quality government bonds catch a bid.
Investors are looking for a place to park their money while they figure out what is going on.
But at this early stage, it is not a full-blown panic yet.
Not yet. The adjustment is tentative. The markets are essentially testing the severity of the shock.
They are dipping their toes into safe havens, waiting to see if the geopolitical tension is going to de-escalate or if it's going to spiral. They haven't completely abandoned the risk-seeking mindset. They are just hedging their bets.
Holding their breath. But if the tension doesn't blow over, if the geopolitical stress persists and actually escalates, that is when the plumbing of the global financial system starts to warp. That is when we enter the actual mechanics of panic.
Which brings us to the concept of liquidity repricing. This is the absolute core mechanism of a risk aversion regime. This is the engine of the panic.
Let's unpack this engine, because this is the secret to understanding everything that follows. What actually changes in the financial plumbing?
What changes is that investors stop looking at the potential return on their assets and start looking at the liquidity of those assets. They start asking existential questions about the financial system itself.
Like, could we face actual disruptions? Could we be hit by secondary sanctions?
Exactly. Could our supply chains be legally severed? Could there be sudden government restrictions on moving capital across borders?
So the fundamental question shifts from, will this asset go up in value, to, will I physically be able to access my money tomorrow morning?
The golden rule of this phase is that liquidity suddenly becomes infinitely more valuable than yield.
Let's make sure we define that clearly. Liquidity means how fast I can turn an asset into cash without losing money. Yield is how much interest or profit that asset pays me.
Correct. Let's say you own a highly profitable toll road in an emerging market. The yield is fantastic. It generates huge amounts of cash. But you cannot easily sell a toll road in an afternoon.
It's highly illiquid.
Right. In a normal market, you don't care because you want the yield. In a geopolitical panic, you suddenly realize that if capital controls are slapped on that country, your toll road is useless to you. You can't get the money out.
So you prioritize survival over profit. You want assets that you can sell in 1 second flat, even if they pay you zero interest.
And the most glaring systemic indicator of this shift is something called dollar funding pressures.
Let's dive deep into this. Why does the whole world suddenly desperately need US dollars when things get scary?
Because the global financial system runs on the US dollar. The vast majority of international trade is invoiced in dollars. If a company in South Korea is buying oil from a company in Saudi Arabia, that transaction is settled in dollars.
So institutions that operate internationally rely heavily on continuous rolling short-term dollar loans to finance their daily operations and cross-border investments.
The dollar is the lifeblood of global commerce.
When uncertainty spikes, everyone suddenly realizes they need more of that lifeblood just to ensure they can meet their daily obligations.
Imagine a massive European manufacturing conglomerate. They have thousands of suppliers around the world expecting to be paid in dollars next week. Usually, this conglomerate just rolls over short-term dollar debt at their local bank to smooth out these payments.
It is a routine plumbing operation.
But suddenly, a geopolitical shock hits. The European bank looks at the world, gets scared, and decides to hoard its own dollars just in case. They tell the manufacturing conglomerate, "Sorry, we aren't lending out dollars today. We need them."
The conglomerate panics. They have to pay their suppliers in dollars or they default. So they go to the open market and are willing to pay almost any price to get their hands on U.S. currency.
Now multiply that scenario by tens of thousands of massive corporations, banks, and sovereign wealth funds all over the world, all at the exact same time.
The demand for dollar liquidity surges globally.
Everyone wants to hold the currency that is universally accepted.
And this massive simultaneous scramble creates a severe bottleneck. It tightens financial conditions across multiple markets globally. It is a synchronized squeeze. But the real story is how the massive institutional players react behind the scenes.
Oh, absolutely.
Because while the public is watching the news headlines about the geopolitical event, the big money, the asset managers, the pension funds, the sovereign wealth funds, they're quietly and aggressively dismantling their entire portfolios.
Large institutional investors do not sit paralyzed and watch the volatility. They take immediate surgical action. Their response to geopolitical stress is to violently reduce their exposure to anything vulnerable.
If we are thinking about a portfolio manager with $100 billion, what are the very first assets they dump?
They look for assets that are both risky and relatively liquid. Emerging market equities and local currency bonds are usually the first to go. They drop highly leveraged assets.
They abandon cyclical industries that rely on robust global growth. Think industrial metals, consumer discretionary stocks, or global shipping companies.
They sell them, regardless of the underlying fundamentals.
Right.
A company could have a great balance sheet, but if it is in an exposed sector, it gets liquidated.
And where does all that capital go? It shifts directly into instruments that are perceived as unshakable stores of value. We are talking about government bonds issued by highly credible, stable, developed nations.
Yes.
We need to emphasize something critical here. This institutional dumping of risky assets is frequently described as a panic. But it is not an emotional reaction, is it?
It is entirely calculated. It is a strategic mandate for capital preservation. The risk models these institutions use dictate that when uncertainty crosses a certain threshold, capital must be protected at all costs.
They are willingly walking away from potential profits to ensure their survival. They are moving into defensive formations.
Which creates a terrifying new reality for everyone else.
Yeah.
Because when trillions of dollars move into defensive formations, it alters the economic gravity of the planet.
This is the actual formation of the risk aversion regime.
This is the structural adjustment. This is where we see the great reversal.
Let's trace the physical movement of this money during the great reversal.
Think back to the risk-seeking phase we discussed at the beginning.
Yeah.
During that era of abundant liquidity, capital aggressively poured out of developed nations and into emerging markets, high-growth sectors, and frontier economies looking for yield.
A massive outbound tide of money.
As the risk aversion regime takes hold, that tide violently reverses direction. The capital is forcefully redirected back toward safer, developed financial centers. The money floods back to the core.
And when trillions of dollars leave a region all at once, it creates a massive vacuum.
A severe squeeze. Emerging markets experience brutal capital outflows. Imagine a developing nation that relies on foreign investment to fund its infrastructure and balance its budget. Suddenly, the foreign investors hit sell and repatriate their funds back to the U.S. or Europe.
That places immense downward pressure on the emerging market's currency. Their stock market crashes. Their borrowing costs skyrocket because nobody wants to buy their bonds anymore.
The regions that are most sensitive to risk basically get their financial oxygen cut off overnight. And this introduces a persistent new personality to the global market. We enter an era of persistent volatility.
The market becomes hyper-reactive.
Once a risk aversion regime is established, the baseline assumption is no longer stability. The baseline assumption is danger. Markets become incredibly sensitive to any new piece of information. Geopolitical headlines, policy announcements, diplomatic developments, they all carry massive weight.
A minor news headline about a military drill, something that would have been ignored a month ago, suddenly triggers massive price swings.
A single diplomatic statement can send the markets into a tailspin.
Investors are continually, obsessively reassessing risks in real time. It is a sharp, jarring contrast to the calm conditions of normal times. The market has no shock absorbers left. Every bump in the road feels like a car crash.
And this isn't just a bad week on the trading floor. This leads to long-term bunkering.
How long can a regime like this last?
If the underlying geopolitical tensions remain unresolved, these structural shifts in asset allocation can persist for years.
Years. So institutions will just sit in these defensive positions, earning almost nothing for half a decade.
They will increase their holdings of liquid assets, build up massive cash reserves, and completely starve the vulnerable sectors of capital. They will lock their money away until the geopolitical landscape fundamentally changes. Let's zoom out for a second and look at exactly where they are locking it up. Let's look at the hierarchy of global safe havens, the bunkers.
I want to explore these bunkers. When the financial world goes to war, where does the money actually hide? Let's start with the first bunker, the currency anchors.
During a geopolitical shock, you see very specific currencies strengthen dramatically, while others absolutely collapse.
Why is that? Why do certain currencies become life rafts while others become anchors tied to your ankle?
It comes down to institutional credibility, rule of law, and most importantly, market depth. Investors flock to currencies backed by massive, stable economies with highly liquid financial markets. If you are trying to move $50 billion to safety, you cannot put it into a small economy's currency.
Because buying $50 billion worth of a small currency would skyrocket the exchange rate and break the market you are trying to enter.
Precisely. You need a market large enough to absorb massive inflows without malfunctioning. You need a currency supported by a credible central bank that you trust not to seize your assets or suddenly devalue the money.
These specific currencies become global financial anchors when uncertainty rises. Let's look at the second bunker. High-quality sovereign debt, government bonds.
Top-tier government bonds act as the ultimate liquidity anchors for the global financial system.
This is one of the most fascinating ironies in macroeconomics. Even if the broader economic picture is terrible, let's say global trade is collapsing and a massive recession is looming, the demand for these specific top-tier government bonds is so high that their yields actually drop. Let's walk through the mechanics of why that happens.
It comes down to the inverse relationship between bond prices and bond yields. When you buy a newly issued government bond, it pays a fixed amount of interest. Let's say it pays a fixed $5 a year.
Okay.
If investors suddenly panic and desperately want the safety of that bond, they will start bidding up the price of the bond on the open market.
They will pay a premium to own that safe asset.
But the bond still only pays that fixed $5 a year.
Yeah.
So if you pay a much higher price to buy the bond, the percentage return on your investment, the yield actually goes down.
The demand is so overwhelming that investors are willingly accepting terrible returns.
It is a pure flight to safety. Investors seeking absolute stability will blindly purchase government debt as long as it is issued by countries with ironclad fiscal credibility and deep financial systems.
They do not care about the yield.
No, they care about the return of their capital, not the return on their capital. They just want to ensure the money is still there in 5 years.
Which brings us to the ultimate bunker, the oldest one, gold.
Gold plays a very unique, highly specific role in a risk aversion regime.
Because it is completely neutral.
Gold is a bearer asset.
Hmm.
It is not tied to any specific government's balance sheet. It is not someone else's liability. It is not reliant on the electronic plumbing of any specific financial system.
It doesn't care who is the president, it doesn't care what the central bank is doing, and it doesn't care if the SWIFT payment network gets shut down.
Which is why many investors view it as the ultimate politically neutral store of value. Periods of heightened geopolitical tension almost always coincide with a surging demand for gold.
If you fear that governments might default or that financial institutions might fail, gold is the physical hedge against institutional collapse.
Right.
So we have all this capital hiding in currency anchors, government bonds, and gold. We have emerging markets starving for capital. We have extreme hyperreactive volatility. But what makes this truly terrifying is that the system is engineered to amplify the damage. We enter the doom loop.
The feedback mechanisms. Modern financial markets contain structural mechanisms that actively accelerate risk aversion once it begins.
Let's talk about the machine takeover. How does modern financial technology take a geopolitical shock and turn it into a cascading panic?
The primary mechanism is what we call the financial market amplification effect. We are talking about quantitative risk management models, algorithm trading systems, and specific strategies like volatility targeting.
Let's break down volatility targeting. How do these algorithms actually operate?
Many massive funds use models like value at risk, or VAR. These models dictate how much risk a fund is allowed to take based on the current level of market volatility. The algorithm has a strict mathematical limit. If market volatility hits a certain level, the fund must reduce its overall risk.
It's hard-coded. There is no human portfolio manager making a judgment call.
It is entirely automated. So a geopolitical headline drops. It causes a sudden sharp price swing in the market, a tiny bit of volatility.
The computers detect that volatility spike.
And because volatility has increased, the algorithm determined that the fund is now carrying too much risk. To get back under its mathematical limit, the algorithm automatically issues sell orders for riskier assets, like equities.
But when massive funds all hit sell at the exact same time, what happens? They cause the market to drop further,
Which creates even more volatility.
which triggers even more algorithms to sell even more assets.
It is a self-reinforcing downward spiral. It solidifies the shift toward defensive positioning without any human being making a conscious choice to panic. The machines are just following their risk management protocols, but collectively, they accelerate the market crash.
It's funny, you look at these multi-billion-dollar algorithms, the absolute pinnacle of human financial engineering, and the moment a complex geopolitical headline hits, their sophisticated state-of-the-art response is basically sell everything and hide under the bed.
The algorithms lack nuance. They only understand math. And the math says volatility equals danger.
And this is where the financial doom loop bleeds out of the screens and into the real economy. This financial hoarding doesn't just hurt the portfolios of wealthy investors, it actively breaks the everyday world.
That is the tragic reality of a risk aversion regime.
Yeah.
The structural adjustment and the financial plumbing eventually choke the real economy. Because capital is locked in bunkers, corporate credit dries up. Businesses cannot get funding at reasonable rates.
Imagine a company that wants to build a new factory and hire 1,000 workers. They need a loan to do it. But the banks are hoarding capital and the bond markets are frozen, so the company delays the investment. The factory doesn't get built. The workers don't get hired.
International trade slows down to a crawl because nobody wants to take the risk of financing complex cross-border shipments. Supply chains begin to physically degrade because the financial grease that keeps them moving has evaporated.
And inevitably, consumer confidence declines. People feel the tension. They see the lack of investment. They hear about layoffs. They start saving their own money and stop spending.
The perception of risk creates actual, tangible economic stagnation. The financial fear of a recession effectively causes the recession in the real economy.
And governments and central banks are not blind to this. They can see the plumbing freezing up. They try to step in. They try to stop the bleeding.
But fighting a risk aversion regime driven by geopolitical shock is extremely difficult. It is often described as pushing on a string.
Why is it pushing on a string? Why can't the central bank just lower interest rates and fix it?
Because the problem isn't the price of money. The problem is fundamental uncertainty about the future of the world. Central banks can try liquidity injections. They can print money to ensure the plumbing doesn't completely break. Governments can try fiscal stimulus.
You can print $1 trillion to stabilize the bond market, but you cannot print confidence.
You cannot use monetary policy to solve a military conflict or unblock a sanctioned energy pipeline. Once the regime has shifted into risk aversion, market participants are fundamentally psychologically scarred. It takes an immense amount of time and concrete real-world changes to convince them to leave their bunkers. A central bank press release is not enough.
Let's look a little closer at the primary battleground where this all plays out most clearly. The currency wars. Because the macro analysis points out that foreign exchange, the FX market, is where the clearest signs of this regime appear.
Foreign exchange markets are the ultimate, unfiltered scoreboard for a risk aversion regime. This is where you see the flight to liquidity behavior in its absolute purest form.
We mentioned earlier that it is survival of the deepest.
Capital violently concentrates into specific currencies because they offer the greatest operational flexibility during uncertain conditions. Investors ruthlessly prioritize currencies that are associated with the deepest, most liquid financial markets. They need the ability to maneuver.
And the losers in this currency war, we touched on emerging markets, but who else gets punished?
The losers are any currencies linked to commodity exports or high-growth sectors. Think of countries whose entire economy relies on exporting industrial metals, or countries that are heavily dependent on global manufacturing demand.
Because if global growth is slowing down due to bunkering, nobody needs industrial metals.
Pardon me, that's the logical outcome. The revenues of those commodity exporting nations will collapse, which means their currency is inherently vulnerable. Investors rapidly abandon those currencies to reduce their exposure to risk-sensitive economies.
So you get these massive pronounced divergences. The safe haven currencies skyrocket in value, making their exports more expensive, while the commodity currencies plummet, causing massive inflation in those local economies.
It creates enormous stress on the global system.
But here is a detail from the analysis that is genuinely astonishing. This massive shift in the currency markets isn't just a natural phenomenon. It isn't just a flock of birds flying away from a loud noise. Massive financial institutions actually proactively exploit this architecture.
You're referring to strategic FX campaigns. Large financial institutions, hedge funds, and sophisticated asset managers understand exactly how these liquidity shifts work. They know the structural architecture we are discussing today inside and out.
So when a geopolitical shock hits, they know exactly what the massive pension funds and algorithms are going to do before they do it.
They know the structural demand for liquidity is inevitable. They know that within days or weeks, trillions of dollars will try to squeeze through a very small door to get into US dollars or Swiss francs.
So how do they exploit that?
They trade ahead of it. They design macro strategies that align with the incoming capital flight. If they know emerging market currencies are going to be dumped, they will proactively short those currencies. If they know the dollar will surge, they will aggressively buy dollar call options.
They are essentially front-running the global scramble for safety.
Currency movements during these regimes are not purely reactive. Major market participants are strategically positioning themselves to profit from the structural panic.
And by doing that, by actively betting on the panic and pulling their own capital out early, they are actually reinforcing and accelerating the global capital flight. They are pouring gasoline on the fire.
They're acting rationally within the rules of the system, but their actions exacerbate the liquidity drain for the vulnerable nations.
Okay, so let's summarize where we are. The world is in a bunker. Trillions of dollars have flooded back to the core. The algorithms are automatically suppressing any attempt at risk-taking. The real economy is starving for credit. The currency markets have violently stratified between the haves and the have-nots. How does this end? Let's talk about the thaw.
The transition out of a risk aversion regime. It is important to remember that these regimes rarely last indefinitely. The system eventually finds a new equilibrium. But the thaw does not happen on its own, and it does not happen just because assets get cheap.
So investors don't just wake up one day and say, wow, emerging market stocks are at a 50% discount, let's go buy them.
Price alone is not enough to break a risk aversion regime. It requires concrete de-escalation of the geopolitical tensions that triggered the shock in the first place.
You need diplomatic breakthroughs. You need ceasefires. You need the lifting of blockades.
The fundamental systemic uncertainty has to be resolved or permanently contained. You need the threat to the financial plumbing to go away.
Once that threat begins to ease, how does the system reboot?
It starts in the funding markets. Once the geopolitical tension de-escalates, the intense fear of being locked out of liquidity starts to fade. Banks stop hoarding dollars. Central banks manage to successfully stabilize the short-term lending markets.
The plumbing gets unclogged. The money can move again without friction.
Financial institutions finally start to feel safe enough to offer credit again. They look out of their bunkers, they see that the existential threat to the system has passed, and they slowly begin expanding their lending and investment operations.
But it is a slow crawl, isn't it? Panic is instant. The return to risk takes a massive amount of time.
The transition back to risk-seeking behavior is always gradual. Trust is much harder to build than it is to destroy. Volatility measures drop slowly over months. Institutional investors begin cautiously reallocating capital toward equities.
They dip a toe back into the water. They slowly start buying emerging market debt again. They start funding infrastructure projects.
The narrative slowly shifts back. Analysts stop mapping out naval blockades and start projecting economic growth and technological opportunity again.
Confidence slowly returns to the markets that previously experienced the most brutal capital outflows. The regime shifts back to baseline.
The machine switches back to profit mode.
So let's synthesize all of this. What is the grand takeaway from this macro analysis?
The core truth is that risk aversion is not just a temporary emotional panic. It is not an anomaly. It is a structural, fundamental phase of the global financial system. It is the system reacting highly logically to a disruption in the global order.
It is the invisible architecture doing exactly what it was designed to do, preserve the core at the expense of the periphery. And by recognizing these mechanics, by spotting the early narrative shifts, understanding the sudden scramble for dollars, and recognizing the algorithmic doom loop, you are no longer just a passive observer reacting to chaotic news.
You gain a profound insight into how the world actually functions. You can interpret these massive market movements through a geopolitical lens. You understand that when a currency crashes on the other side of the world, it isn't just a local problem. It is a symptom of the global financial architecture shifting its weight.
You can see the invisible strings pulling the global economy. But as we wrap up this deep dive, we need to look forward. We've mapped out this cycle. We go from the illusion of stability to a geopolitical shock, to a deep freeze of risk aversion, and eventually back to a thaw.
The historical cycle.
But look at the state of the world today. Look at the increasing friction in global trade, the realigning of supply chains, and the escalating tensions between major powers. As the global order continues to fracture and superpower competition becomes the daily new normal, we have to ask a terrifying question. What happens if the risk aversion regime stops being a temporary phase we transition in and out of and simply becomes the permanent state of the global financial system? Where does the capital hide when there is no longer a normal to go back to? Think about that. Until next time.